At the end of the day, choosing the right business at the right price is what we want to do. And, we just let the chips fall where they may from there. Because over time, we've learned that the reality is if you make the right decisions, fundamentally, you're with the right businesses, those fundamentals will win out over time.
If you're watching this on YouTube, make sure you smash that like button and click subscribe. For those of you listening on a podcast platform, be sure to subscribe on whatever platform that is and leave us a rating if you can. The more likes, ratings, and subscriptions that we get, the more we can spread the message and grow our community. So we also have a free Facebook group. It's called the Average Joe Finances Network. Check us out, join the group, join the community, ask questions, and become a part of the team. All of our other social media accounts are listed in our flow page, and we have them in the video or podcast description below. All right. Hey, how's it going, everybody? So today's guest is Brian Dress, and Brian has 15 years experience in the investments industry. Before joining Left Brain, he spent nearly a decade managing an independent portfolio of derivatives focused mainly in the oil and gas commodities markets, but also in equities and fixed income. Brian has earned his bachelor's in international relations with a concentration in international economics from Georgetown University in Washington, D.C. He is currently a candidate for the Chartered Financial Analyst, the CFA designation. Brian is a resident of the city of Chicago, where he lives with his wife, Michelle, and young daughter, Juliet. In his spare time, he enjoys spending time with his family, working out, cooking, and traveling. Awesome. Hey, Brian, thanks for coming on the show. Glad to talk with you today.
It's great to be here, Mike. And I want to throw a shout out as well to my newest daughter, which is Alexandra. She's about to turn 2 as well. So
there we go.
A little update on the bio there.
Fantastic. Well, welcome to the world, Alexandra. So awesome. Hey, so I'd like to start this off the same way I start every show. And, I spoke a little bit about your background there, but, it was brief. So if you could share with us your story, like what got you started? What made you want to go down this road working in finances?
Sure. So I attended Georgetown in the School of Foreign Service, so internationally focused. I took a course on international finance, and I learned about George Soros and kind of what he was up to in the currency markets. And from that day, I just remember the day. From that day, I was interested in markets. And so when I got done at Georgetown, moved up here to Chicago, and got involved in futures trading. Started out in the bond markets, and also got involved when oil was ripping and roaring back in the 2007, 2009 timeframe. So it's a good time to be in the mix there. So everything I was doing was pretty much short-term trading, a little bit of long-term investing on the side, but not too much. So I did that until about 2018. Things leveled off in that business. Algorithmic trading came into the mix and sort of pushed out folks like myself. And so at that time, I decided to look for something a little more durable in the markets, and that's long-term investing. And that brought me over to Left Brain, wealth management, capital management, where we do a lot more long-term investing, exclusively long-term investing and growth-oriented. So I made a change in career on the fly. But I'm really happy and fulfilled that I did so, just because I feel like a few things. Long-term investing is really the way to go. Feel really comfortable with that. And also the opportunity to work with clients and help them build their wealth, preserve their wealth, and meet their goals and dreams financially. So, so I've run the gamut from short-term trading all the way now to long-term investing. Happy I'm here today speaking with you.
Awesome. Thanks for that. Yeah. So, you definitely got to, like you said, run the gamut. I mean, you worked both sides of the house, right? From short term back in 07 to 09 to where you're at right now with Left Brain working on long-term retirement portfolios. I mean, that's a huge difference. So now what about you personally? So what is Brian Dress doing on his own journey to financial independence?
So I heard this quote last week from an old friend, and he said, I'm a work in progress until progress makes work optional. I think that really resonated for me. In the financial world, we're all trying to find a way to build wealth, create wealth, preserve wealth. And it's all in service of a goal, which is financial freedom. And, as we spoke before, I've been all over on all sides of the financial world. But what I've really learned is that long-term investing, there are a number of reasons why there are advantages in long-term investing. But at the essence is what you're really trying to do is help your work, have your money work for you rather than you work for your money. And that's the essence of what we do at Left Brain, building portfolios that are going to help people, build their nest egg and preserve it when they get it to a point where they feel like it's going to cover the dreams and goals that they have. And so I'm fully on that path, fully on that long-term investing path, and putting my money to work that way as I build my career.
All right. Yeah, good deal. So I really like that quote. That's awesome. Now, okay, so with Left Brain, your focus now is on long-term investing, and that's what you're helping your clients do, right? So what are some of the advantages of, investing long-term, particularly relative to short-term investing?
Sure. So we all know that making decisions in the financial markets is difficult. Every decision you make, buying and selling, requires thought, consideration. And the reality is in short-term investing, you really have to make a lot of really good decisions. So if I buy today, sell tomorrow, buy again tomorrow, sell again 3 days from now, that's a lot of decisions. However, if I buy a stock, I got to find a company that I feel comfortable with. So that's one decision. And then there's another decision, which is exiting the investment. So it's two decisions. And you come to realize, mathematics tells you the more positive decisions you can make, the better you're going to be. And the reality is nobody can make 100 good decisions per year. It's very difficult to do. So that's the first reason that long-term investing is so much better. Also with long-term investing, we're buying businesses. We're not playing a number. We're not playing the markets. It's overbought today. It's oversold tomorrow. In the end, the fundamentals win out. So if I have a company that I feel comfortable with, their business model, the trajectory of that business model and everything else, the management there, I can stick to those principles, and over time, it's going to win out. So that's the second advantage. And then the third advantage is taxes. So with short term in the US, any investment you make that is for 1 year or less, you're going to pay at your income rate. Whereas if you hold it for more than 1 year, it's going to be paid at your capital gains rate, which is generally quite a bit lower. It's different in different countries, but in the US, that's definitely the case. And so, those three put together really makes a case for long-term investing. And, I think a lot of people want to chase that short-term buck, and they want to make, 100% return in a year on an investment. And I understand that impulse. I lived in that world. But I also want to say it's possible to do in the long-term investing world as well. There are a number of companies, especially in 2020, that doubled in just that year. And I wouldn't want to go out and say that's an expectation of ours, but it's not just slow money. It's not boring. There's opportunity to make significant returns through long-term investing. It's just because sometimes the stars just align, and you have the timing right and the business right. But at the end of the day, choosing the right business at the right price is what we want to do. And we just let the chips fall where they may from there, because over time we've learned that the reality is if you make the right decisions, fundamentally you're with the right businesses, those fundamentals will win out over time.
Yeah, I mean, right on. While you were talking, I was taking some notes, and I feel like, there's some key things I want to point out with what you said, with long-term investing versus short-term investing. And that's the fact that, one, it's a lot less decisions you have to make, right? If you're buying something and you're holding it for the long term, there's not really much else to do with it afterwards. You're not messing around. You're not turning around and selling it and trying to buy the dip or anything like that, right?
Right.
So a lot less decisions that you have to make. The other thing that you talked about too is like your comfort level. That again, it's something that you have to worry less about, right? Especially if you're with a company that you can trust, that you've built this relationship with over time. And then the other thing is the tax advantage, right? If you're doing short-term investing, like a lot of the people that listen to the show that are doing day trading, like I know that they're experiencing a lot of capital gains taxes that they have to pay, right? And that's something that you're not worrying about as a long-term trader or as somebody who is, investing for retirement.
Yeah, I would just, in terms of taxes, I think, we look at what's on our screen. And so, I make a buy, I make a sell, I own that profit. That's what it says on the screen. But at the end of the day, it's what do I take home? And I think,
right.
The more experience you gain in the markets, the more you understand that. And so managing for taxes, while not the primary concern, it's a secondary concern, but you have to do so. And, at the end of the day, we'll make buys and sell decisions on long-term holdings to optimize taxes for our clients. So, if there's a big capital gain, we'll be looking around for a stock where we feel we could sell and harvest a loss and put the two together and optimize taxes. And so I would just caution those. And I think it's an experience thing. I think a lot of people get into day trading and they don't think about the taxes, and then they get the rude awakening one time, and then you change your whole viewpoint on it. So again, primary focus is making money gross, but net is really the number one bottom line. And so managing taxes is part of the equation.
Yeah, right on. That's exactly the thing, is if you have somebody else that's managing it for you and that has the experience, that's been doing this for a while, it's a lot less you have to worry about. And that goes back to that whole comfort thing. So I know, like for me, I've got my thrift savings plan being in the military. And, that's one of those I set it and forget it type deals. I change my allocations every now and then. And that's really it. I don't really have to worry about it. But then like my little fun money account that I have that I bought to do like more active trading with, I found myself actually buying and holding some real estate investment trusts, some more long-term like dividend paying assets, and that was with my play money that I had to just mess around with and speculate. And I found myself just going back to the playing it, more safe and it's doing well. Like I just checked it yesterday afternoon, and I was up 30.17% for the year. So I'm pretty happy with that. And that's, again, it was about a comfort thing. I was, I wanted to mess around and play around with it more, but I decided not to speculate, and it's doing well. So
you've learned the lesson quickly.
I've learned a couple lessons playing around in there, and that's why, it doesn't have too much money in there. But yeah, I've also learned a couple lessons that when I tell myself I'm going to buy and hold something, just because it goes up significantly in value, I shouldn't just sell it because I doubled my money, right? One in particular, I'll talk about this. There was when I bought Plug at $2.02 a share, and it went up to like $4.14. I put like $4,000 into it. So it was, I had 2,000 shares, and it doubled in value. So I sold it for a profit of $4,000. It was now worth $8,000. So I said, hey, I doubled my money. Good to go. Right. Well, if I would have held it for 3 more months, when it went up to $68 a share, that would have been $500,000. So that was a lesson learned too. Like, hey, I told myself I was going to buy and hold it, but I still sold it. So little things like that, people will hopefully learn from. I know I did. So now the other couple like smaller stocks that I bought into, I don't really mess around with penny stocks too much, but the smaller ones that I bought into, I'm like, I'm sticking it out. I'm going to wait and hold it for at least a year or two and see what happens. And of course, I wound up paying capital gains taxes on that.
Anyway, I want to get back into what you guys do with Left Brain, right? And I know you have like a specific investment philosophy, and your philosophy, is basically a way to help others achieve financial goals and their dreams. So, can you explain that philosophy?
Sure. So the first part of it is what we've been talking about, long-term orientation. And the second part is that we're looking for growth stocks in general. I would go ahead and caution and say, every client's different, and we put different clients in different allocations based on their circumstances, but we really like growth stocks. And so we go where the growth is. And, in the past, we've been heavy in tech, but that's not because we just love tech. It's because that's where the growth was. And so, coming out of the pandemic, we're seeing some new areas of growth. And so a little bit of reorienting as well as we go through kind of the economy reopening. But, the basis of our philosophy is we like world-class businesses. And so it's not a really complicated philosophy or process, but we're looking at a number of key factors in every company that we assess. And the number one, again, is growth. So we're looking for revenue growth, but we're looking for an acceleration in revenue growth. So, I love to see a company that grew 30% last year, and then this year, 40%. That shows you a trajectory that is telling you a story with the numbers. You go behind the numbers, you're probably going to find out that something is happening either in that company's markets or the way they're addressing that market and in their market share. So that's the first thing. But with growth stocks, there is risk. And so we have to find a way to manage risk. And so that way is we're looking for a trajectory toward profitability or profitability on some metric, whether it be free cash flow or net income. And so, we have to find a risk management tool. A lot of these companies that are growing fast are losing money hand over fist. And I'm not to say that we would never invest in a company like that, but we are looking for a company that has that path to profitability. And then kind of a qualitative concept is category definer. We want a company that is a category definer or a category killer. And I always pick on this company, but Oracle. We love companies that are competing with a company like Oracle or IBM. Finding a way to do something better, to beat a legacy business. So that's one. And then, we want a benign competitive environment. We want a large growing market where competitive dynamics are in our favor. And then the final, and I think maybe the most important is management. We really like companies that are founded, that are run by their founder CEOs. And there are a few reasons for that. It's the innovation, it's the vision, and then it's the alignment of interests. You see a lot of these founder CEOs that have, 98% of their net worth in the business that they're running, that they founded. And we love investing with alongside CEOs that have their skin in the game. So I would say that I tell a lot of people this: investing is simple. It's not easy, but it's simple. And we have just like these five main points that we look at in every business. And it really guides our assessment of all those different companies and gives us a chance to, select 25, 30 that we think are really the best in their category and have great growth potential. And then we try to put our money behind those.
Right on. I think you spoke a little bit about your process too, because that was the next question I was going to ask you. And how do you go about selecting companies to build this long-term success? So, I think it's pretty good because your philosophy just ties right into that, to your actual investment process for how you select these companies. And the way you explained that, just the way that you're looking for the growth, the acceleration versus the risk, their trajectory, risk management of the company. But what I really like is that something that you said about when you're looking at these companies that have a founder or CEO that, has a large portion of their net worth tied into the company, so that they have skin in the game. That's a huge thing that you always hear about all the time. Hey, if I'm going to follow somebody, I want to make sure they have skin in the game. And that's, I think that's a really great factor that you guys consider. So that's really awesome.
Yeah. And in terms of process, I think that people who are outside the investing world, they look at it and it's just, as people would say, it's all Greek to me. It seems complicated, but what I like to tell people is, if you can't handle it, find someone that can help you do it. But if you're determined to do it on your own, I tell people, find a company that you're familiar with, maybe that you worked for at some point, or you have a friend that worked there, or have familiarity on some level. And then most of our research is looking directly at corporate filing. So we like to look at the 10Ks and the 10Qs, and that's a little bit daunting, but the real value is each quarter you can read that earnings call and hear directly from the management, the CEO, the CFO, and they're required to tell you what's going on. They can't hold back by law. So if you want to learn what's going on in a company, read the last 2 conference calls, read the next one, and you'll start to get a sense of what's going on. And that's why I say, use a company that you're familiar with, because, maybe the language is a little bit difficult to understand in the conference call. But if you have that, that earlier knowledge of that company, you can start to put it together and start to understand that cadence that, the CEO speak, and start to, sift through that and understand more how companies work. And, we have, really 2 reasons why we will ever sell an investment. And the first is, we find a better investment. So say I own 30 stocks. I want to buy that 31st, but we want to get rid of the one that we have number 30. So that would be the first reason. And then the second reason is business changes. So our thesis is based on, we expect X, Y, and Z product to come out and make whatever percentage of growth for that company. If that changes, that's when we're looking to sell. That's our sell discipline. But the only way to know that is to keep up with the company and read the quarterly filings. And again, I understand it may be daunting if you've never been in the business and never taken the time to do that, but there's so much valuable information in there. And I think you'd do a lot better spending an hour reading a company conference call than you would be, watching CNBC for that 400th hour of the year.
Yeah, right on. I got to admit too, for my day job, I'm in the Navy, and I always have CNBC on in the background in my office. So a lot of times, it's a lot of chatter all the time. But I tend to not really absorb too much of that, because there's so much more to what just a couple talking heads are talking about when it comes to investment strategies. So speaking of that, so let's say there's somebody out there who, wants to start investing long-term. They want to start building their, portfolio towards retirement. How would somebody get started? Like somebody who just started their career, brand new, and they want to start investing. What's the right steps for them to take?
Let's take a brief moment to hear from our show sponsors. What's going on, everybody? So today I want to talk to you about the podcast editing service that we use for the Average Joe Finances podcast. That is editpods.com. And what I really like about them is it's a subscription-based service, so the prices are fantastic. And not only do they do the podcast episodes for us, but they also make us videos, audiograms, social media caption videos. They do our show notes, thumbnails. It's just fantastic products. Go check them out at editpods.com. What's going on, everybody? So today I want to talk to you about Wealth Tender. If you are a finance content creator, whether that's a blog, a podcast, you're a financial advisor or a financial coach, I highly recommend you check out Wealth Tender. Wealth Tender is building a database of all the top finance blogs, podcasts, and the financial advisors and financial coaches that they have on there are vetted and top-notch. So we actually had the pleasure of hosting Brian Thorpe, the CEO and founder of Wealth Tender, on Average Joe Finances podcast episode 25. Go check out that episode, listen to his story, and listen to him talk about the database that he's building. It's really phenomenal stuff. So if you're interested in checking out the directory, or if you're a finance content creator and you're interested in joining up with the directory, go to the link below in the show notes or check out www.averagejoefinances.com/wealthtender. Let's get back to today's episode.
Well, I would just say initially you just have to get going, because I understand this. I spent all that time in the short-term world. I had money to use to invest long-term, but I was sort of reticent to do it because I felt, the edge was in the short term. And I also felt I don't know where to start. Like I said, getting started with reading some of these earnings calls is the way to go. But then I also think you got to consider the way you view risk. So I understand, like, it's always risky to be invested in anything. But we have to think about, if I'm just getting started in my 20s or 30s, I've got 40 or 50 years of investing ahead of me. And so time is on my side. If you go back and look at the last 100 years of the stock market, you'll notice that you'll have a hard time finding a 25 or 30 year period where the market was actually down for that period. And so, you got to get started and get on that wheel and, let the money start moving for you. I think a lot of times we look at stocks that we like and maybe they'll go up and then they start coming back down and we start getting really antsy, anxious. And I would encourage people to look at that in a completely different way. So I used to think, man, I own stock X and it went down 20%. It's time to get out. But if that long-term mentality, and that's powered by understanding the company, you start to realize that 20% pullback is an opportunity for you to add exposure, not to take away exposure. And I know everybody says
discount.
Yeah, everybody says buy high and sell low, buy low and sell high. And it's easy on paper to say that, but I know it's difficult to do in practice. I know from my point of view, when things pull back, I don't feel good about it. But over time, the experience teaches you that no, you really need to buy when things are down. You don't need to be selling. And my experience is the more times you do that and get the feedback of, I bought and 3 months later, it looks so much better. You start to realize that's the way to do it. And that's the way that wealthy people invest, not only in the stock market, but in, real estate and a number of other ventures is, buying things when they're on sale and then maybe selling when it's overvalued. That's the way to do it. That's the mindset you need to have, but you got to push past that initial fear, which is in everyone. It's in all of us. So if that means doing it on a small size, on a small dollar amount, that's the way to go, but you got to get started.
Yeah, no, I agree. Key thing there, just start. Get in, get yourself in, get your own skin in the game and start investing. Okay. So I like a lot of what you were talking about there because I tend to have that same kind of mentality. So it kind of makes me more comfortable with what I'm doing myself. It's I don't sit here and freak out when things dip. I look at it as an opportunity to buy that asset again at a discounted price and lower my dollar cost average per share. So that's awesome. Unless there's some particular, like there was one that I bought into. I bought it at a certain price and it dropped and dropped and dropped. It got down to like $9. And then there was a call for it to be at $1. And I was like, it's time to go. But yeah,
right. Like we say, it's, if something changes, that's different, but if a lot of the time markets are volatile and sell-offs happen for reasons other than the fundamentals. Yeah. A lot of time, sometimes a hedge fund blows up or someone just needs to sell a few $1 million of shares or whatever it will be. That has nothing to do with the business. And right. So like we said, it all comes down to the business. If the business is not what we thought it was 6 months ago, we'll make a new decision. But if nothing's changed, man, it's really an excellent opportunity to add that exposure. And especially in growth stocks, you'll find it's hard to buy a lot of them because you'll feel these are expensive stocks, and they are. They rarely go on sale, but when they do, it's really, truly an opportunity to get in.
Yeah, absolutely. And the other way I looked at it too is, especially since that portfolio is still up, it's up 30%, like I said, that to me was a tax write-off, so that's the way I looked at it. I feel a lot better about it that way. And I let it go.
Well, let me just say this is it's better to get out of that position and, you save your mental energy rather than holding on to that, hoping it's coming back. And, I think a lot of times people just get spun up mentally. And again, this is going back to long-term investing. I think it's so much easier when you make a lot fewer decisions. You don't get that anxiety. You don't get that spun up feeling. And, my experience is one bad decision can lead to 5 bad decisions. And again, the fewer decisions you make, the less opportunity you have to get yourself in trouble that way.
Yep. No, I agree. All right. So speaking of, the lesser amount of decisions to make and that whole comfort level, how frequently should someone talk with their advisor?
So by law, we're forced to do at least a yearly review. So we do that. But, we want to be in touch with our clients, and we tell them, give us a call at any time you feel uncomfortable with things. And, my view of the advisor role is we're trying to be a buffer between investors and their emotions and the markets. And so, we want to be there and making the decisions in the hard times and doing that, buying the dips when it feels terrible, lightening up the load when things really run. And I always encourage people to try not to look at your account every day because that really leads again to that anxious feeling. And, again, we like to talk to our clients whenever they feel. But the frequency doesn't need to be extreme. It really doesn't. We're happy to keep everybody abreast of what's going on. We do, events here and there where we invite everybody and kind of give our clients a state of the union and that sort of thing. But it's all about education. So the longer we've had people under our roof working with us, they start to become more comfortable with that concept of buy and hold, staying calm. And we actually get a lot of calls when the market comes down and saying, hey, is this an opportunity to put more in? And that's when you really have succeeded in terms of educating your clients. And that's why I like being on programs like yours, because we want to be out here educating people in the investment universe that A, you need to be in the stock market, and B, there's a better way to do it than just, the jittery in and out concept that you see on TV all the time. And unfortunately, the philosophy that we espouse, you don't see it out there anywhere near enough, in my opinion.
Yeah, no, I agree. And it is super important. Education is super important when you're anything involving your own money, right? You want to know what you're getting yourself into. So it is important to do that research, especially if you're looking at a company, like if you guys want to check out Left Brain, do your research on them, listen to this episode, listen to me and Brian speak about this. And go check out their site and see if it's a company you'd be interested in checking out. But the important thing is doing that research, doing your own due diligence to make sure that you're putting your money somewhere where you're comfortable. And this word has come up several times during this show is comfort, right? So you want to make sure you're doing something that you're comfortable with your own money, right? So really awesome, Brian, really awesome. So do you have any last tips or tricks that you would recommend to a new investor?
I think it's, I take a little bit of issue with the way you asked that is there's really no tricks to it. It's, staying the course. It's doing the homework. It's educating yourself, and it's having a plan and sticking to that plan. And the problem with finance is, a lot of people are selling product. A lot of people are trying to get you to do a certain thing for their particular aims. And it's not necessarily client focused. And the way we work is we're fiduciaries. And that means whatever is best for the client is what we need to do, what we have to do, what we're forced to do. And we want that to be the case. And, I don't want to be out here selling products. I don't want to be out here pushing particular investment concepts. I want to be out here educating people and helping them make good decisions. And again, there's really no shortcut to doing a little bit of homework and learning about the companies you invest in. And so I really encourage people to try to do it on their own if they have the time and the inclination and the interest. But if you don't, you really need to be working with somebody that can help you and grow your money. the power of compounding is huge. And we know that, you can make 8 to 10% in the stock market, but if you're actively choosing companies, maybe you can make a couple more percent or 4 more percent. And over time, that really adds up in a really spectacular way at times. Again, there's always risk of loss in investing, but if you can have a process that's replicable and that you can stick to, you really have an opportunity to grow your money really well in the stock market, in the bond market, and in a number of financial markets. But again, there's no shortcut, and you really have to do the homework. And if you don't have the time or the inclination, you got to find somebody that does do the homework.
Perfect. Yeah. And you know what? There's something I want to point out that you were talking about there. So people that are listening understand the difference between a fiduciary and somebody who's just going to sell you a product, right? So fiduciaries, like they have your best interest in mind no matter what. So what Brian's talking about is, his focus is going to be, or any fiduciary's focus is going to be on making sure you're educated to make the decision on your own. And then you work with them to build your investment plan versus somebody saying, hey, here's this product or here's this policy, buy into this and, whatever and versus, focusing on what they're going to get their kickback for their commission versus somebody who truly has your best interest at heart. So I just want to point that out, that it's super important. That is a key word, fiduciary.
Yeah, fiduciary in the context of wealth advisory is, we make a percentage of folks' portfolios under management. So it's in our best interest to grow their portfolio, and that's the way we do business. And when they do well, we do well, and that's the bottom line of a fiduciary.
Fantastic. Really appreciate that, Brian. Hey, really appreciate you taking all this time to chat with me today. I have one more important question that I have to ask you, and this is probably the most important one of all. And that is, for the folks that are listening right now, where can they find more information about you? Can you share your website, any social media accounts or anything like that?
Sure, there's a few. So the good place to start would be www.leftbrainwm.com. That's the website for our advisory business. And we have some affiliated businesses as well, including a new mutual fund that we have launched recently. So head over to that website and check us out. You can find us on Twitter at leftbrainir. And then the last thing I like to tell people is, feel free to reach out to me on LinkedIn directly, Brian Dress. I love talking about investments with anyone. So, any questions that might come up, if anything we're talking about is of interest to you and you want to learn more, feel free to reach out to me and I'm happy to address those questions.
Fantastic. All right. Hey, so Brian, I'll make sure I have all of those links in the show notes, including your social media links as well. Again, seriously, really appreciate you taking some time today to chat with us and help educate the audience on what it is that you guys are doing at Left Brain. I really appreciate it. Thank you.
Thanks, Mike. It's been a pleasure.